Hello super traders and welcome. Today we have an interesting show. We have Andrew Saks from LeapRate with us. Hello Andrew.
Hello.
How are you?
Good, nice to see you again.
I like your suit.
Thank
Very
you.
nice. How
Do
are
you
you?
like my suit as well?
Well, I'm not going to. No, you look well as well, Yaron. Today we have a very interesting topic that we're going to talk about. We're going to talk about the potential demise of the European Union. I would love to hear from you too what you think about this topic, but let's go by subject one after another. First, let's start with the Greece debt. Andrew, I would love to hear from you. What do you think about the Greece debt connection to the potential demise of the European Union?
I think there's a connection between that, and at the moment we're at a real crux because the Greece is not really a major participant in the electronic trading industry at all, but it is potentially a catalyst towards the separation of that particular country from the European Union, mainly because it racked up a large debt, and this was actually not really necessarily the blame for that doesn't necessarily lie at the door of Greece itself, but more at the European Central Bank a few years ago, which loaned 190 billion euros to Greece.
And they're not going to see it coming back in the near future.
They're never going. They'll never see it because the whole basis of this loan was a loan which was secured on collateral that was worthless. They put 190 billion euros into loaning to Greece. And why did they do that? Because Greece is a non-producing country that couldn't sustain itself. So then, bearing that in mind, they then secured that debt, as we spoke last week, they secured that debt on those failing Greek banks, which is a worthless collateral. So now, it comes to the point where the European Union is stretched financially. That loan was a third of the capitalisation of the whole European Central Bank.
Wow.
And it is not sustainable. So now, it comes to the point where they need to pay it back. Greece cannot pay it back. So instead of making any attempt whatsoever, they voted in the socialist Syriza party.
And they're even asking for more money from the European
Union. And their prime minister, who is a rebel, if you want to call him that, is encouraging them to spend so that they could. Because what have they got to lose, really? Not much. So of course, if they go out of the European Union, this potentially could cause a very, very sharp downturn to start with in the euro.
If they're going to leave the Eurozone.
Yes, if they leave the Eurozone, it will cause a sharp because there are those in more industrial countries that think that if Greece goes out, then it will do them good. Yes, potentially yes, but they don't have the money the whole European Union does not have the money to satisfy that debt first before rebuilding itself. So it will cause the euro to crash, and the problem is that the euro is a major currency, and now we have got Forex companies and banks with large Forex trading desks that handle order flow across the interbank market. We've got them starting to worry about what may happen if the euro surges downwards in value. So, for example, you have now Denmark, which has its own currency, is talking about capital control laws. We reported yesterday that Denmark, of all that you associate capital control laws with places like China or Argentina or Venezuela, communist countries where they use it to control the population and stop any international business. But free market economies with highly developed financial markets economies like Denmark,
yes,
talking about putting in place capital control laws so that it stops any effect on Denmark wants to maintain its peg with the euro. So the kroner's peg with the euro. So they will go to any extent to do that, which is the opposite measure to what Switzerland did last month. So Switzerland cut the peg off, preserved itself, and you saw the massive appreciation of the franc against the euro. And
because it disconnected from the euro.
It appreciated. It finished some forex companies. They are insolvent, and they are now in the hands of receivers, including Alpara UK, which was a previously well-capitalized company, is now in the hands of the receivers. FXCM was exposed to $225 million of client negative balances within one day. And that's the biggest forex brokerage in the United States. So that happened, but Denmark is now doing it the other way around, where it wants to maintain some kind of capital control law to maintain the peg, and they've been selling foreign currency, they've been buying extra, printing extra kroner. This is potentially very dangerous thing to do.
For Denmark, if
Yes.
the Eurozone is going to collapse.
Yes, because they are purposely keeping their own currency, but they are devaluing it on purpose to stop it becoming a safe haven for investors. Switzerland has always been, it's a traditional
safe haven, yes.
Very, very well organised. It's old-fashioned. There is not much technology there. It's a, in my opinion, a kind of wood-panelled, glass crystal decanter chambers of old-fashioned banking.
But right now, Switzerland is not going to be affected in any change by the Eurozone.
They cut themselves off,
yes.
and they did it without any. I see it as them pulling up their drawbridge. They did it without any worry about the consequences of doing so. So they've safeguarded themselves, and you saw the result was huge exposure to negative balances across the forex industry abroad. Now, if Greece goes out of the European Union and the euro then starts collapsing like that, imagine the liability to a lot of electronic brokerages.
Wow, it's going to be major influence. Yes.
But do you think that the agreement to extend the bailout funds to Greece for four more months is just a time bomb?
Yes.
It's just a time bomb.
Yes, without doubt. It certainly is.
What do you think we're going to see in 4 months from now?
Well, I think in 4 months, the thing is, because of what's happened over the last month, since January the 15th, there's been a kind of short-termist approach taken by a lot of, not just end users, but actual forex companies as well, which are taking a short-termist approach because they're concerned about any future removals of pegs to European currency. And they are reliant on capitalizing their entire business on order flow, volume. So you know, out of their small amount of spread, they have to pay for their platform, they have to pay for their technology system, they have to pay for their connection to liquidity, they have to pay for their prime brokerage. So they're looking short term to try and keep that going. So of course this extension gives them 4 months to keep it as an equilibrium and make as much order flow as possible in that time. But I think that would be a mistake. The thing to do really is to look abroad to the Far East, which a lot of companies are doing now. London is considered the largest financial sector in the world, and that's part of the European Union. But most of the order flow is going to Hong Kong, Singapore, China nowadays. In the interbank market, it's going to the Asian financial markets and North America and Russia, not Europe. So I think that the effect of that will be that if Europe disbands, there will be, within the interbank sector, a huge deficit on euro currencies, and that will be, then you will see things like platform companies trying to recoup the losses they've made because companies won't be able to pay for their platforms, and a large negative client balance exposure. And then potentially London may be less affected because it already has all of those interbank sector there, HSBC, UBS, which is a Swiss bank, but most of their FX order flow is London, Barclays, RBS, all of them have major units in the Far East, as do all the major electronics. IG Group has, Saxo Bank has, it's a Danish company, but they're in Singapore, they're in Hong Kong, they're in very many Far Eastern markets. So I think that they are more interested in that.
But let's try to summarize about the Greece debt. Do you think that the fact that Greece is going to be disconnected from the Eurozone, if they're going to leave them or not, in 4 months, is going to have a major influence on the European market?
Yes, it will, because those who don't use those 4 months to think of a way of going somewhere where there's a stable potential future order flow, for example, young active trading population, stable currency, growing market, lots of manufacturing industry, and they don't use that. If after 4 months the European Central Bank and the IMF says no more bailouts, you've had bailout after bailout and you're still not producing. And
Greece is going probably to leave the Eurozone.
Right, and if they leave, which they probably will, because that's the whole ethos of their new party is that they're not going to pay that debt back. They don't have a chance. They will just leave. They will probably either go bankrupt and have the European Union sue them for the debt.
Can the European Union sue another country because they're having a bad? No?